Stock investment for financial freedom. I want you to meet two friends. Both graduated from Ohio State University in 2015. Both started their first jobs in Columbus, earning the same salary, $45,000 a year. Both lived in small apartments downtown, and both had big dreams for the future. The only difference between them was a decision they made over dinner at Applebee's one evening. The first friend, Michael, said that evening, "I'm going to start saving and investing $500 every month, no matter what, whether the S&P 500 goes up or down." The second friend, David, laughed and replied, "Now? I'm only 25. I should be living my life. I'll think about this when I'm 35. Besides, what good will $500 do?" 10 years passed. The calendar read 2025. Michael had $185,000 in his Vanguard account. He had only invested a total of $60,000. The rest was a gift from the market and time. Now, when the alarm went off every morning, he didn't have to go to work. He was someone who went because he wanted to go. David, however, still woke up with the same worries. His Visa and MasterCard debt had reached $25,000. Half of his monthly salary went to bills and student loans. And worst of all, even if he started now, he would need to deposit 3 times more money each month to catch up with Michael. Do you know what made the difference? A decision. A single decision. And the discipline not to postpone that decision. If you're listening to me right now, you're probably at a crossroads too. Maybe every morning when the alarm goes off, you think to yourself, "I wish I didn't have to go to work." Maybe you get excited when payday comes, but when you check your account on the 15th of the month, you don't understand where the money went. Maybe you've been saying "I'll be rich one day" for years, but you don't have a concrete plan. If so, I understand you very well, and I can help you. Because this story isn't just Michael and David's story. It's the story of millions of people. Maybe it's your story. Let's look at the statistics. 78% of working people in America live paycheck to paycheck. That means 78 out of every 100 people. If one paycheck is late, they face a serious financial crisis. 64% of those reaching retirement age still have to work because they don't have enough savings in their 401k or IRA accounts. But here's the thing. It's not because of low wages, because 60% of those earning 6-figure salaries are in the same situation. The reason is this. No one taught us how to make our money work for us. They taught us calculus in school, but they didn't teach us compound interest. We took literature classes, but we didn't take financial literacy classes. The result? Most of us work for money our whole lives, but we don't learn how to make money work for us. But now, I want to give you some good news. Financial freedom is not a coincidence. It's not a matter of luck either. It doesn't require working on Wall Street. It doesn't require graduating from an Ivy League school. Financial freedom is the result of conscious decisions, systematic thinking, and patient action. And the best part is, it's possible for everyone. Warren Buffett, the man who rose from Omaha to become one of the world's most successful investors, says, "There are 2 rules for building wealth. Rule 1, never lose money. Rule 2, never forget Rule 1. And then he adds, "The most important rule is start early. Whether you're 25, 35, or 40 years old right now, what matters is your decision to start, because the best time to start was 10 years ago. The second best time is now, today." When you finish this book, you won't be David anymore. You'll be Michael.
because over the next 2 hours, you will learn, step by step, the path to financial freedom. No, I won't tell you the 3 secrets to getting rich. No, I won't promise you becoming a millionaire overnight. Those are fairy tales. I will tell you the truth, the power of systematic, patient, and conscious investing. Roadmap. What will we learn? Over the next 10 sections, we will embark on a journey together. First, we will prepare your mind, because wealth is not an amount, it is a mindset. You will see the difference between rich and poor thinking, and you will decide which side you want to be on. Then you will discover the power of time. We will see with numbers why compound interest is called the 8th wonder of the world. And you will understand that the excuse, "I don't have time," is actually a lie. Then we'll move on to practice. What is a stock? How does it work? Which company should you choose? How should you build your portfolio? We'll learn all this without getting into complicated Wall Street jargon, as if we were explaining it to a friend. Then we'll talk about psychological traps, because your biggest enemy is the person you see in the mirror. You'll learn how to break free from the cycle of fear and greed. Then we'll cover risk management and capital preservation, because preserving your wealth is just as important as becoming wealthy. We'll talk about winning the long-term game. Patience is the most profitable investment strategy, and you'll internalize this. And finally, you'll take action. With a 30-day action plan, you'll take your first step, because knowledge is power, but action is freedom. What will change for you? When you finish this book, you will no longer wake up in the morning filled with anxiety, but instead start your day with hope, because you will know you have a plan for your future. When your paycheck arrives, you will pay yourself first. You will apply the pay yourself first principle.
And you will see that money working for you. When your friends say, "I won't take risks," you will say, "I'm managing risk." When you imagine 10 years from now, you will see that you are no longer someone who has to work, but someone who wants to work. Financial freedom is not quitting your job and sitting on a beach in Florida. Financial freedom is freedom of choice. The freedom to do the work you want, to travel where you want, and to spend time with your loved ones. And this freedom is much closer than you think. You just need to take systematic steps. Now, I want one thing from you. Listen and take notes. Yes, you heard right. Open a notebook or a note app on your phone, because this isn't just a motivational book. It's a book of action. In each chapter, I'll give you actionable steps, and my only request is don't skip those steps. You don't need to open a Robinhood or Fidelity account yet, or buy and sell stocks. Learn first, then take action. Hasty decisions come at a high cost. Conscious decisions bring wealth. Now take a deep breath, because the journey ahead could change your life. And remember, it all starts with the decision to listen right now. If you're ready, let's move on to the first chapter. In this section, you will see the difference between rich thinking and poor thinking, and you will decide which side you want to be on. Let's get started. Chapter 1. Wealthy Mindset versus Broken Mindset. In 2010, in Manhattan, at Goldman Sachs's office, 2 young analysts were working side by side at their desks. Both had recently graduated from Harvard Business School. Both earned $85,000 a year. Both dreamed of a big career in the glittering world of Wall Street. The first analyst, Jennifer, automatically transferred 20% of her monthly salary, about $1,400, into her Vanguard account. While her coworkers were having cocktails at happy hour, she was at home reading books.
While everyone else leased new BMWs, she still took the subway and quietly invested. The second analyst, Brandon, did the exact opposite. "I have to live my youth," he said. Designer suits, fancy dinners, weekend trips to the Hamptons. His credit card debt was piling up, but he thought, "I'll pay it off as my career progresses." And when the calendar showed 2025, exactly 15 years later, Jennifer's net worth had exceeded $1,200,000. Her portfolio was generating $4,000 in passive income each month. She was still working at Goldman, but she no longer had to work. She chose to work. Brandon, meanwhile, was still trying to maintain the same lifestyle. His credit card debt had reached $65,000. Half of his monthly salary went toward paying off debt. And at night, he couldn't sleep, because he knew that if he got laid off, he wouldn't last 3 months. So what made the difference, you ask? It wasn't IQ, not luck, certainly not a Harvard degree. They both went to the same school. They worked at the same company. The difference was their mindset. It was their way of thinking. Why can't most Americans get rich? According to the Federal Reserve's 2024 report, 64% of Americans have a net worth below $100,000. So with 20 or 30 years left until retirement, most people's savings are less than a year's salary. What's even more sad is this. Even 45% of those with an annual income above $100,000 live paycheck to paycheck. How is that possible? You earn $100,000, but you have no savings. The answer is simple. High income does not equal wealth. Wealth is not about how much you earn. It's about how much you keep and how you make that money work for you.
The problem isn't money. The problem is mindset. Most people live with a broken mindset. They try to look rich, but they aren't rich. They share a luxurious lifestyle on Instagram, but their bank accounts are empty. They drive rented BMWs, but their retirement accounts are zero. Real rich people are the opposite. They drive Honda Civics, but their portfolios are 7 figures. They wear T-shirts, but their passive income is over $10,000 a month. They look ordinary, but they are financially free. Now I'm going to show you 2 different ways of thinking, and you decide, which side do you want to be on? Mental differences, broke versus rich. Difference 1, concept of money. The broke mindset says money is meant to be spent. I should live off what I earn. YOLO, you only live once. Jennifer's coworker Brandon was exactly like that. When his paycheck arrived, he was in money's here today, gone tomorrow, let's spend it mode. An $8 latte from Starbucks every day, a $25 salad for lunch, a $200 night out at the club on the weekend. The wealthy mindset says money is a tool for working. I don't work for money. Money works for me. Jennifer, on the other hand, looked at every dollar like this. This $10 will be $174 in 30 years. Should I put it toward an investment or spend it on something unnecessary? Instead of spending $8 at Starbucks, she made coffee at home and put that $8 toward an investment. Over 30 years, $8 per day times 365 days per year equals $2,920 per year. Compounded at an average 10% return, that daily Starbucks money turns into approximately $480,000 over 30 years. Yes, you heard right. Daily Starbucks or retirement security? The choice is yours. Difference 2, risk perception. Broke mindset says the stock market is too risky. I'll lose money. It's safer to keep it in cash. This thinking seems logical, doesn't it? But let's look at it this way. Imagine you put $10,000 in a savings account in 2010. At 0.5% interest, it would total $10,770 in 15 years.
But with an average inflation rate of 3%, its real purchasing power would drop to $6,500. So the safe choice made you 35% poorer. The wealth mindset says everything is risky, but risk is manageable. The real risk is taking no risk at all. If you had invested the same $10,000 in the S&P 500, it would have grown to approximately $45,000 between 2010 and 2025. That's a 350% increase. Yes, there was volatility. In 2020, there was the COVID crash, and it fell by 30%. But those who held on won. Warren Buffett has a famous saying, "Risk comes from not knowing what you're doing." Risk stems from ignorance. For the informed investor, there is no risk, only opportunity. Difference 3. The concept of time. Broke mindset says, "I'm young, I have plenty of time, I'll start when I'm 40. I should enjoy myself now." Brandon thought exactly like this. He said, "I'll have fun until I'm 30, then I'll get serious." But here's what he forgot. Time is compound interest's greatest power. Every year you delay makes a difference of hundreds of thousands of dollars. The rich mindset says, "Time is my most valuable asset. Every day that passes either makes me money or costs me money." Jennifer started at age 25. Brandon started at age 35. Just a 10-year difference. But the result? Jennifer invested $1,000 per month for 10 years between ages 25 and 35. A total of $120,000. Then she never stopped investing. She just let the compound effect do its work. At age 65, $2.1 million. Brandon, on the other hand, invested $1,000 per month for 30 years between ages 35 and 65. Total investment, $360,000. At age 65, $1.8 million. See? Jennifer invested 3 times less money but earned more. Why? Because time in the market is better than timing the market. Difference 4. Spending versus investing. Broke mindset says, "I got a $2,000 bonus this month. Let me buy myself a new iPhone and take my friends out to dinner." Instant gratification, momentary satisfaction.
The $2,000 came in and the $2,000 went out. The wealth mindset says, this $2,000 is an opportunity to acquire an asset, either stocks, a down payment on rental property, or an investment in skill development. Jennifer thought this way with every bonus. How does this money serve future Jennifer? One year, she received a $5,000 bonus. Her friend said, "Let's go to Hawaii." Jennifer replied, "No, I'm going to invest this money in dividend stocks. That stock will give me $300 to $400 in dividends every year. In 10 years, those dividends will take me to Hawaii every year." And that's exactly what happened. Difference 5. Ego and wealth. Broke mindset says, "It's important that I appear successful to others. Designer clothes, luxury car, luxury apartment. Imagine it." That's why they live in a $3,500 studio apartment in Brooklyn and make $800 monthly payments on a leased BMW. They wear Balenciaga sneakers and have $50 in their bank account. Are you going to pretend until you succeed? No. Fake it until you break it. The wealth mindset says, it's not about looking rich, it's about being rich. It's not about ego, it's about freedom. The book The Millionaire Next Door studied millionaires in America. The result is surprising. Most millionaires drive a Toyota Camry, shop at Walmart, and live in normal neighborhoods. Why? Because what matters to them isn't appearing rich to others. What matters is not having to go to work when they wake up in the morning, not having to attend a meeting they don't want to attend, not having to get approval to go on vacation. True wealth is freedom. Wealth is freedom. True story, Warren Buffett. We can't finish this section without mentioning Warren Buffett. Warren Buffett is currently one of the 10 richest people in the world. Net worth over $120 billion. But he still lives in the $31,500 house he bought in Omaha, Nebraska in 1958. He eats breakfast at McDonald's. He drove a Honda Civic for years. Why? Because he never developed a broke mindset.
At age 11, he bought his first stock, City Service. 3 shares, $38 per share. A total investment of $114, borrowed from his uncle. The stock first dropped to $27. Warren panicked, but he held on. Then it rose to $40, and he sold immediately. He made a $2 profit and was very happy. But that stock rose to $200 over the years. If he had held on, he would have made 6 times his money. That day, Warren learned 2 lessons. Patience is very important. Patience is essential. Think long-term, not short-term. And since that day, he has been investing according to the same principles for over 70 years. The result? $120 billion. You and I will never be Warren Buffett, but we can apply his principles. And those principles work for us, too. Analyze yourself. Now be honest with yourself. I'm going to ask you 3 questions. Answer mentally. Question 1. Think about the last thing you bought that cost over $500. Was it an asset, something that will make you money, or was it a liability, something that will cost you money? Example, you bought a laptop and started an online business. Asset. You bought a PlayStation 5 and play FIFA. Liability. Question 2. How many months of expenses do you currently have in your bank account? 0 to 1 month? 1 to 3 months? 3 to 6 months? Or 6+ months? If your answer is 0 to 1 month, you have a broke mindset. If it's 6+ months, you're on the path to a wealthy mindset. Question 3. In the last 3 months, did you buy something you saw on Instagram thinking, everyone's buying it, I should buy it too? If you answered yes, you're spending based on your ego. A wealthy mindset invests in value, not trends. These questions aren't meant to judge you, but to see where you stand, because without knowing where you are, you can't plan where you're going.
This week's task. Now I'm giving you a challenge. This week, just 7 days. Task. Track every single purchase you make. Every single dollar. $5 at Starbucks, a $30 impulse buy on Amazon, $25 on Uber Eats. Write it all down. And next to each expense, note, was this a need or a want? Need. Food, rent, utilities, transportation. Want. Starbucks, DoorDash, Netflix subscription, new hoodie. At the end of the week, look at your want spending. You'll be surprised. Most people spend $500 to $1,000 a month on wants and don't even realize it. That $500 can turn into $300,000 over 30 years. The choice is yours. Track it, analyze it, and ask yourself, is this money working for me, or am I working for the money? In the next section, we'll see the real power of compound interest in numbers. We'll learn about what Einstein called the 8th wonder of the world,
If you're ready, let's continue. Chapter 2. The Hidden Power of Compound Interest. Boston, 2005. Two roommates graduated from MIT, Jake and Tyler. Both earned engineering degrees. Both started working at tech startups in San Francisco, with an annual salary of $65,000. On graduation night, while having their last meal at the Cheesecake Factory, they had a conversation. Jake said, "I'm going to invest $500 every month for 10 years. Then I'll stop. I'll invest a total of $60,000 and leave it there." Tyler laughed. "I'm smarter than that. I won't start now, but in 10 years, when I'm 35. By then, my salary will be higher. And I'll invest $500 a month for 30 years, a total of $180,000. Does that make sense? Tyler's plan seems better, right? After all, he'll invest 3 times more money. It's 2025, 20 years later. Jake's Vanguard account? $742,000. He only contributed $60,000 over 10 years. Then he never touched it. Tyler's Vanguard account? $367,000. He invested exactly $180,000 over 20 years. And he's still investing.
Jake is twice as wealthy as Tyler. How did that happen? The answer is one word: compound interest. What Einstein called the 8th wonder of the world. Now I'll show you this magic. The myth that small amounts don't matter. Most people think, what good is saving $100 a month? That's only enough for 3-4 coffees at Starbucks. It won't make me rich. Or, I can only invest $1,000 right now. What difference will that make? I might as well spend it. This mindset is why millions of people never become wealthy, because what they don't see is this. Compound interest is like a snowball. It starts small as it rolls downhill, but it grows every second. And as it grows faster. And it becomes an unstoppable force. First 5 years? Well, it's grown a bit, you say. Second 5 years. Wow, it's grown nicely, you say. Third 5 years. How did this happen, you say. And fourth 5 years. This is now unstoppable, you say. Now let's do some math. But not boring math, life-changing math. What is compound interest? How does it work? Simple interest versus compound interest. First, a simple example. Simple interest, you deposit $10,000, you earn 10% per year. Year 1, $10,000 plus $1,000 equals $11,000. Year 2, $11,000 plus $1,000 equals $12,000. Year 3, $12,000 plus $1,000 equals $13,000. Each year, you only earn interest on the initial $10,000. Compound interest. You deposit $10,000, you earn 10% per year. Year 1, $10,000 plus $1,000 equals $11,000. Year 2, $11,000 plus $1,100 equals $12,100. Year 3, $12,100 plus $1,210 equals $13,310. See? In the second year, the $10,000 you earned also started earning money. In the third year, it earned money too. This is called interest on interest, interest on interest, earnings on earnings. The difference seems small in the early years, $13,000 versus $13,310. You might say, no big deal. But wait, let's look at 30 years later. Simple interest, 30 years, $40,000. Compound interest, 30 years, $174,494. Same $10,000, same 10% return.
But the result? 4 times more. That's where the magic happens. Have you ever gone skiing in Colorado? Imagine rolling a snowball down a hill. First meter, small snowball, fist-sized. 10 meters later, basketball-sized. 50 meters later, beach ball-sized. 100 meters later, a huge, uncontrollable mass. Compound interest works exactly like this. First few years, well, it's grown a bit. First 10 years, nice, it's continuing. Year, wow, it's grown significantly. Year, how did it get this big? Because growth is exponential, not linear, not flat, but layered. 95% of Warren Buffett's net worth came after he turned 60. Why? The last 20 years of compound interest are more powerful than the first 40. The two-sided effect, investment versus debt. But be careful, compound interest can work for you or against you. In investment, for you, you invested $1,000 in an S&P 500 ETF. It earns an average of 10% per year. After 10 years, $2,594. After 20 years, $6,726. After 30 years, $17,449. Credit card debt against you. You take on $1,000 in credit card debt. APR is 20%, average credit card rate. After 1 year, if you make minimum payments, $1,200. After 5 years, $2,488. After 10 years, $6,192. See? Compound interest works both ways. It either makes you money or takes money from you. That's why wealthy people say, never carry credit card debt, but always invest. Numerical examples, real-life scenarios. Scenario 1. Early starter Emily, age 25. Emily started at age 25. She contributed $500 per month, only for 10 years, until age 35. Then she stopped. She never touched it. Total contribution, $60,000. 10 years times 12 months times $500. Balance at age 65, $1,116,000. Based on a 10% average annual return, the historical average of the S&P 500. Scenario 2, late starter Alex, age 35. Alex said, "I'm younger. I want to have fun." At age 35, he got his act together. For 30 years, until age 65, he contributed $500 every month.
Total contribution, $180,000. 30 years times 12 months times $500. Balance at age 65, $1,028,000. See? Alex invested 3 times more money than Emily, but he ended up less wealthy. The difference? Time in the market. Emily started 10 years earlier than Alex. Those 10 years created a compound effect that changed the outcome. Lesson? The best time to invest was 10 years ago. The second best time is now. Scenario 3. The Starbucks Paradox. Daily Starbucks latte is $6. 30 days a month times $6 equals $180. Per year, $2,160. It's just coffee, you say, but now look at this. If you had invested that $6 a day in a Vanguard S&P 500 ETF for 30 years, total balance, $376,000. Yes, your daily Starbucks latte, potentially $376K. Now, ask yourself, is that 5-minute caffeine rush worth it? I'm not saying never go to Starbucks. I'm saying be aware, make a conscious choice, know the trade-off. Maybe Starbucks twice a week, coffee at home 5 days. Then you enjoy it and save over $250K. Scenario 4. You're not too late. Let's say you're 45. You say, I'm too late. No. Let's see. You started at 45. You contributed $1,000 per month for 20 years until age 65. Total contribution, $240,000. Balance at age 65, $687,000. Still a solid nest egg for retirement. Still a comfortable life on top of Social Security. It's never too late, but the earlier you start, the easier it is. Real-life application, 4 steps. Now we move from theory to practice. How do you use compound interest? Step 1, the pay yourself first principle. When your paycheck arrives, pay yourself first, before bills, before entertainment, before spending. Example, monthly net income, $4,000. 10% equals $400, automatically transferred to Vanguard. The remaining $3,600 living expenses. Automatic transfer, out of sight, out of mind. This way, you won't find yourself saying, oh, I had money, I spent it.
Step 2. Use a Roth IRA or 401k. There are tax-advantaged accounts in the U.S. Use them. Roth IRA, $7,000 per year, 2025 limit. Tax-free growth, tax-free withdrawals at retirement. 401k. Does your employer match? Don't leave money on the table. Pre-tax contribution, tax-deferred growth. Example, company matches 5%. You put in 5%, they put in 5%. Instant 100% return. Step 3. Start with an S&P 500 index fund. If you don't know which stock to buy an S&P 500 index fund, like VOO, Vanguard, SPY, State Street. Why? Diversified exposure to 500 large companies. Historical average, 10% annual return over 100 years. Low fees, around 0.03%. No need to pick stocks. Even Warren Buffett said, when I die, I'm leaving my wife 90% S&P 500 ETFs and 10% Treasury bonds. Step 4. Hands off. The hardest step, but the most important. Don't panic sell when the market drops. Don't take excessive risks out of greed when the market rises. Just let it be. Example, the 2020 COVID crash. The market dropped 30%. Those who panicked sold. Those who waited earned over 50% within a year. Patience is profit. First step this month. All right, theory is over. Now it's time for action. This month, invest your first $500. Don't have $500 yet? $100, $50. It's not the amount that matters, it's the habit. How to do it. Today, open an account with Fidelity, Vanguard, or Charles Schwab. Takes 15 minutes. Online, free. This week, transfer your first funds. Whatever you have, it doesn't matter. First purchase. Buy an S&P 500 ETF, VOO or SPY. If you can't buy a whole share, buy a fractional share. Most platforms support this. Set up Auto Invest. Transfer $100 to $500 automatically each month, 1 day after payday. That way, you don't even have to look at it.
A year from now, you'll remember this moment and say, I'm glad I started. 30 years from now, this moment will have changed your life. Compound interest is the reward for the patient. Are you patient? Chapter 3. Dispelling the I don't have time myth. The time paradox. Sarah is an ER nurse in Los Angeles. She works 12-hour shifts in the emergency room. Night shifts, weekends, holidays. Her life is chaotic, exhausting, unpredictable. In 2018, a friend talked to her about investing. Sarah's response? I don't have time for that. Look at my schedule. And she really didn't. She came home from work exhausted. Gym, meal prep, laundry, Netflix. Learn to invest, too? But her friend asked, Sarah, how many hours a day do you spend on social media? Sarah thought, I don't know, maybe an hour? Check your screen time, her friend said. Sarah looked at her iPhone's screen time feature, shocked. Daily average 3.5 hours. Instagram, TikTok, Facebook, 24.5 hours a week, 98 hours a month. At that moment, she realized it wasn't that she didn't have time. She was spending her time on other things. That day, she made a decision. She would spend 2 hours a week, Sunday mornings from 8 to 10 a.m., learning about investing. No excuses. Fast forward to 2025, 7 years later, Sarah's portfolio, $145,000, and she still only spends 2 hours a week. She set up an automated system, minimal maintenance. Sarah now says, saying I don't have time meant it wasn't a priority. We have to be honest with ourselves. The too busy culture. There's a culture in America. Being busy is seen as being successful. How are you? Busy, so busy, crazy busy. It's as if being busy is a badge of honor. But the truth is, being busy does not mean being productive.
Most people are busy, but broke. They're very busy, but make no financial progress. Why? Because they spend their time on things that aren't important, things that are urgent, but not important. And they never make time for things that are important, but not urgent. Investing falls into the important, but not urgent category. If you don't do it today, nothing happens tomorrow. But if you don't do it for 10 years, your life changes. Time illusion. What are you actually doing? The statistics are shocking. Average American. Daily social media, 2 hours 27 minutes, 2024 data. Daily TV/streaming, 3 hours 9 minutes. Total screen time, 7+ hours. 49+ hours of screen time per week. That's more than a full-time job. When you say, I don't have time, the truth is, you spend 7 hours a day in front of a screen. Now, ask yourself, what if just 5% of those 7 hours, or 20 minutes a day, went toward financial education? Priority versus excuse. Time for brutal honesty. You have time, you're just prioritizing other things. You find 6 hours to binge watch a series on Netflix, but you can't find 15 minutes to open a Vanguard account. You find 2 hours to scroll through Instagram, but you can't find 30 minutes to listen to a financial podcast. This isn't a time problem, it's a priority problem. Think about it. If someone said to you, if you give me an hour of your time tomorrow, I'll give you $10,000. Would you find the time? Of course you would, because you would prioritize it. Investing is the same. There's just no immediate reward. There's a delayed reward. And most people are weak at delayed gratification. The power of automation. Here's the good news. Modern investing isn't like it was in the 1980s. You no longer need to read the Wall Street Journal every day, call your broker, or make trades.
Thanks to automation, opening an account, 15 minutes, online, one time. Setting up auto invest, 10 minutes, runs once a month. Portfolio check, 15 minutes, once a month, optional. Total time commitment, 1 hour the first month, then 15 minutes per month. That's 3 hours a year, less than a movie. Those 3 hours could make you a millionaire in 30 years. Worth it, right? Practical system, minimal time, maximum return. Weekly system, 2 hours. Sarah's system, anyone can do it. Sunday morning, 8 a.m. to 10 a.m., 2 hours. First month, setup phase. Week 1, write down financial goals, do research, which platform, which account type. Week 2, Open an account. Fidelity, Vanguard, or Charles Schwab. Fund it. Week 3, first ETF purchase, VOO or VTI. Set up Auto Invest. Week 4, budget plan, expense tracking, optimization. Total 8 hours in 1 month. 8 hours that will change your life. Subsequent months, maintenance phase. Weekly Sunday check, 15 minutes. Quick portfolio glance, not for panic, for awareness. Skim financial news. Are there any major events? Budget adjustment if necessary. 1 hour per month, much less than Netflix. And some months you may not need to look at all. The system runs automatically. Auto Invest continues every month. Daily habit, 10 minutes. While drinking your morning coffee, listen to a 10-minute podcast. Recommendations: The Dave Ramsey Show, Personal Finance Basics. Invest Like the Best, Investor Interviews. The Motley Fool Money Stock Market Weekly Recap. While driving your car, on the subway, make dead time productive. 10 minutes times 365 days equals 60-plus hours per year of financial education. No one can say, I don't have time to listen to podcasts. You already listen to music. Just change the topic.
Monthly review. 15 minutes. Once a month at month end. Portfolio performance. How much plus minus? Contribution. Did Auto Invest work? Expense review. Any unnecessary subscriptions. Cancel Spotify if you don't use it. 15 minutes. Shorter than a Starbucks line. Inspiration. Details of Sarah's success story. Let's go back to Sarah. She's an ER nurse, the one who said, I don't have time. Start, 2018. Sunday, 8 to 10 a.m. 2 hours of research set up. Opened a Fidelity account, selected Target Date Fund 2055, hands-off, auto rebalancing. Auto Invest, $400 per month, automatic from paycheck. Process, 2018 to 2025. Only checked 4 times a year, quarterly. Never traded, never panic sold. Only increased contribution, $400 to $500 to $600. Total time spent, approximately 3 hours per year. Result, 2025. Portfolio, $145,000. Total contribution, $38,000. Gain, $107,000. Only compound effect and market growth. Time spent, 7 years times 3 hours equals 21 hours total. 21 hours earned $107,000. That's over $5,000 per hour. Even the best ER nurse doesn't earn that much. Sarah is now free from financial stress. She has an emergency fund, her retirement is on track, and most importantly, self-confidence. I'm in control of my financial future, she says. Mark your calendar. Now, starting right now, task, open your calendar now, immediately. Pause this audiobook and do it. Write down Financial Freedom Hour for Sunday morning, 8 to 10 a.m. Recurring weekly, next 4 Sundays. For the first 4 weeks, this slot is sacred, non-negotiable, no excuses. But I want to sleep in on Sunday mornings. Then move it to 9 a.m. or move it to Saturday, but do it. But I might have plans with friends. Then do it Friday night, 8 to 10 p.m. There's flexibility, but there must be commitment. If it's not in your calendar, it won't happen. Simple as that. After 4 weeks, the system will be established, and you won't even need those 2 hours anymore. 15 minutes a month will be enough. 30 years from now, this 4-week commitment could make you a millionaire. Is it worth it? You decide.
Chapter 4. What is stock and how does NASDAQ work? The Starbucks Story. Seattle, 1992. Howard Schultz was looking for capital to grow Starbucks. At the time, there were only a few coffee shops in Seattle. He had a big dream, but no cash. What did he do? He took the company public. He did an IPO, Initial public offering. In other words, he sold part of the company to the public. He entered the stock market. 1992 IPO price, $17 per share. Split adjusted, that's about 53 cents today. Let's say you invested $1,000 that day. You would have bought about 1,887 shares. Today, in 2025, that investment is worth about $178,000. You didn't just spend money on Starbucks lattes, you owned Starbucks. You were a shareholder, and you got a piece of every latte sold. That's the power of stock ownership. Now, I'm going to explain what stock is, how it works, and how you can become a shareholder too. The stock market equals casino perception. Most people view the stock market as gambling, a casino, a game of chance. You buy a piece of paper and either you get rich or you go broke. The risk is very high. This perception keeps millions of people away from wealth creation. But the truth is, the stock market is not a casino. Buying stock is not like buying a lottery ticket. Buying stock means becoming a real owner of a company. Ownership, equity. When you drink coffee at Starbucks, you're a customer. But when you buy Starbucks stock, you're an owner. The difference is huge. Now let's explain this in simple terms. What is stock? Basic concepts. Stock equals company ownership. Imagine you and 3 friends are opening a pizza restaurant. Total cost, $100,000. Everyone puts in $25,000, so everyone has a 25% ownership stake. The restaurant is profitable. Annual net profit is $40,000. Everyone gets $10,000. This is your dividend. Also, the restaurant becomes popular. Someone says, "I want to buy your 25% share for $50,000. You accept. Your initial investment was $25K. You sold it for $50K. $25K profit. This is your capital gain. That's what stock is exactly. Only instead of a pizza restaurant, companies like Apple, Tesla, Amazon. How does stock make money? 2 ways. Capital gains, increase in value. You bought Apple stock at $150. A year later, it's $200. You sold it. $50 profit per share. Dividends. Some companies distribute their quarterly profits to shareholders. Example, Coca-Cola. It pays dividends every quarter, every 3 months. If you have 100 shares, you get about $180 in dividends per year. Cash comes into your account. What some prefer: young investors, growth stocks like Apple, Tesla, no dividends but high value appreciation. Those nearing retirement, dividend stocks like Coca-Cola, Johnson & Johnson, stable income stream. How does the stock market work? Simply put, it's a platform that brings buyers and sellers together. You want to buy Apple stock. Someone wants to sell. The stock exchange, either NYSE or NASDAQ, matches you. The trade happens. NYSE, New York Stock Exchange, the oldest and largest stock exchange, has a physical building on Wall Street. Traditional companies like Coca-Cola, Walmart, Berkshire Hathaway. NASDAQ, electronic exchange, no physical trading floor, primarily tech companies, Apple, AAPL, Microsoft, MSFT, Tesla, TSLA, Amazon, AMZN. You say buy AAPL on Robinhood or Fidelity. Within seconds, the trade is executed on NASDAQ. You are now an Apple shareholder. Ticker symbols. Every company has a code, a ticker symbol. Apple, AAPL, Tesla, TSLA, Microsoft, MSFT, Amazon, AMZN, Google, GOOGL. These codes make buying stocks easier.
Instead of Apple, you type AAPL. It's globally recognized. Reinforcing with examples. Example 1. Apple's journey in 2010 to 2025. In 2010, the iPhone 4 had just been released. Apple stock price, split adjusted, approximately $10. If you had invested $1,000 that day, you would have bought 100 shares. In 2025, Apple stock, $180. Fluctuates, but for example, your 100 shares, $18,000. Return, 1,700%, or 17x growth, in just 15 years. You used an iPhone, you bought a MacBook, but if you were a shareholder, you wouldn't just be a customer, you'd be an owner. Example 2. Amazon's crazy growth. 1997 IPO, $18 per share. Split adjusted, around $1.50. 2025, $3,500 per share. Fluctuates. If you had invested $1,000 in 1997, today, approximately $2.3 million. Yes, you heard that right. $1,000 could have turned into $2.3 million. Of course, no one knew in 1997 that Amazon would grow this much. But one thing is certain, those who never tried had no chance of winning. Example 3. COVID crash and recovery in 2020. March 2020, pandemic, market crash. S&P 500 fell over 30%. Panic everywhere. Whoever sold realized a loss. Whoever held on or bought more? December 2020, market returned to pre-COVID levels. 2021 reached all-time highs. Example, Apple fell to $60 in March 2020. It reached $130 in December 2020, a 116% increase in 9 months. Lesson? The biggest gains in the market come right after the biggest declines. Don't panic sell. Be patient. Common misconceptions. Misconception 1. I need a lot of money to buy stocks. Correct. You can buy stocks for as little as $5 with fractional shares. Robinhood and Fidelity support this. Misconception 2. I have to check the price every day. Fact. Long-term investors may not even check once a month.
Misconception 3. The timing has to be perfect. I have to buy at the right moment. Fact. Time in the market beats timing the market. Start early, hold. Myth 4. Only rich people make money in the stock market. Fact. Everyone who invests in the S&P 500 gets an average annual return of 10%. It doesn't matter if you're rich or poor. First Steps Guide. How to get started. Step 1. Choosing a brokerage. First, you need a brokerage account. You can think of it as a brokerage firm in Turkish. Top choices. Fidelity. No commission. Free trades. Great research tools. Excellent customer service. Strong retirement accounts. IRA. 401k rollover. Vanguard. Low-cost index funds. Long-term investor focused. Retirement account specialist. Slightly more traditional interface. Charles Schwab. Commission.
Misconception 3. The timing has to be perfect. I have to buy at the right moment. Fact. Time in the market beats timing the market. Start early, hold. Myth 4. Only rich people make money in the stock market. Fact. Everyone who invests in the S&P 500 gets an average annual return of 10%. It doesn't matter if you're rich or poor. First Steps Guide. How to get started. Step 1. Choosing a brokerage. First, you need a brokerage account. You can think of it as a brokerage firm in Turkish. Top choices. Fidelity. No commission, free trades. Great research tools. Excellent customer service. Strong retirement accounts. IRA, 401k rollover. Vanguard. Low-cost index funds. Long-term investor focused. Retirement account specialist. Slightly more traditional interface. Charles Schwab. Commission-free. Great mobile app. Has branches if you want in-person help.
Robinhood, super user-friendly, ideal for beginners. Fractional shares, instant deposit, but research tools are limited. My recommendation? If you're a beginner, go with Robinhood or Fidelity. If you're a long-term serious investor, go with Fidelity or Vanguard. Step 2. Opening an account. Online, it's very simple. Required information: Social Security number, ID, driver's license or passport, bank account info for fund transfer. The steps are the same on all platforms. Sign up, enter personal info, link bank account, identity verification, automatic 1 to 2 minutes, funding, transfer your first funds. Instant approval on most platforms. You can trade on the same day. Step 3. How to make your first trade. Let's say you chose Fidelity. First purchase S&P 500 ETF, VOO or SPY. Open the app, type VOO in the search bar, Vanguard S&P 500 ETF, click the Trade button, select Buy, enter the amount, dollar amount, for example $100, or share count, for example 1 share. Order type is market order, buy at the current price, review, and submit. Done! You are now a shareholder in 500 companies. Alternative, if fractional shares are supported, you can even buy Apple with $10.
Don't open an account yet. Learn first. Don't rush to Robinhood and open an account right now. Why? Because in the next section, you'll learn how to choose which stock to buy. Buying randomly is worse than making an informed decision. What did you learn in this section? Stock equals ownership, not a casino. Earnings through capital gains plus dividends. What NYSE and NASDAQ do. Brokerage options, Fidelity, Vanguard, Robinhood. What we'll learn in the next section? Which stock should you choose? Stock Picking 101. 5 characteristics of a good company. Apple, Coca-Cola, and Johnson & Johnson breakdown. What is diversification? Learn first, then act. Knowledge is power. Impulsive action is loss. Chapter 5. The Art of Choosing the Right Stock. Coca-Cola in the 2008 crisis. Financial crisis. Lehman Brothers collapse. The market is crashing. The S&P 500 has fallen by over 50%. Panic mode everywhere. There's an investor on Wall Street, Bill. His portfolio is a bloodbath. Tech stocks have crashed. Bank stocks have tanked. But he has one stock left, Coca-Cola. It's down 30%. His friends say, sell it, it'll drop even more. Bill thinks, will people stop drinking Coca-Cola during a crisis? No, they might even drink more because of stress. He didn't sell. He even bought more. It had dropped from $40 to $25, so he bought more. Fast forward to 2025. Coca-Cola stock, around $63 average. His investment, plus 150% return, plus dividends every quarter. Why was he successful? Because he chose a good company. A quality company survives even in times of crisis, then thrives. Now I'm going to teach you how to choose a quality company. Which stock should you choose? What should you look for? Think like Warren Buffett. Stock paralysis. There are thousands of stocks, over 2,800 on the NYSE, over 3,300 on NASDAQ, over 6,000 publicly traded companies in total. Beginners get confused. Which one is good? Which one is bad? Where should I start?
And the result? Analysis paralysis. There are so many options that you end up doing nothing. Or, worse, random selection. Tesla is trending. Let's buy it. GameStop is hot on Reddit. Let's buy it. Acting on FOMO. This is a recipe for disaster. The good news is, stock picking isn't rocket science. With simple principles, you can separate the good companies from the bad ones. Warren Buffett's principle: invest in what you understand. Invest in companies you understand. Now let's learn those principles. Basic analysis principles. Principle 1. Invest in companies you understand. Warren Buffett did not buy tech stocks like Microsoft and Cisco during the tech boom of the 1990s. Why? I don't understand them, he said. Everyone said,
Buffett is late, he missed out. But Buffett didn't care. He invested in what he understood. Coca-Cola, Gillette, American Express. And he was right. The dot-com bubble burst in 2000. Tech stocks fell by 80 to 90%. Buffett's portfolio remained stable. Lesson: if you can't explain what a company does to a 5-year-old, don't buy it. Example: Apple makes phones, laptops, tablets. Understandable. Check. Complicated biotech startup. It creates new protein molecules using gene editing. Unclear. X. If you're not a biotech expert, don't buy biotech stocks. You understand consumer products, tech devices, food and beverage. Invest in those. Principle 2. 5 characteristics of a good company. Characteristic 1. Strong brand. Coca-Cola, Apple, Nike. Everyone knows them. There is brand loyalty. People are willing to pay a premium. Ask yourself, will this brand still be relevant in 10 years? If you say maybe, there is risk. Feature 2. Consistent revenue. Look at the financial statements. Is revenue increasing every year, or is it up and down? Example: Johnson & Johnson. Revenue growth every year for the last 10 years. Stable. Check. Volatile tech startup. One year 100 mil, next year 30 mil. Unpredictable. X. For beginners, stable revenue is safer.
Feature 3. Profitability. Revenue isn't enough. There must be profit, because if revenue is increasing but the company is losing money, it's not sustainable. Metric to look at: net profit margin. Formula: net income divided by revenue times 100. Good company, 10% plus profit margin. Example: Apple's profit margin, about 25%. For every $100 in revenue, $25 in profit. Excellent. Feature 4. Low debt. Look at the debt-to-equity ratio. How much debt does the company have relative to its equity, shareholders' equity? Ratio less than 0.5, very good. Ratio 0.5 to 1, good. Ratio greater than 2, risk. Example: Apple's debt is manageable. Microsoft's debt is minimal, good. Feature 5. Competitive advantage. Buffett calls this a moat, protection around the company. Competitors cannot easily enter. Apple's moat, ecosystem. You buy an iPhone, then AirPods, Apple Watch, iPad. Locked in. Coca-Cola's moat, 100-year-old brand, global distribution. Question: can this company's competitors easily copy it? If yes, there is no moat. Principle 3. Simplified P/E ratio. P/E ratio equals price to earnings ratio. Price-earnings ratio. Formula: stock price divided by earnings per share, EPS. What it means: how much are you paying for this stock's $1 of earnings? Example: Apple stock, $180. EPS, annual earnings per share, $6. P/E ratio, 180 divided by 6 equals 30. P/E equals 30 means you are paying $30 for every $1 of Apple's earnings. How to interpret: P/E less than 15 may be undervalued, cheap, or there may be a problem. P/E 15 to 25, reasonable. P/E greater than 30, expensive or high growth expectations. Tech stocks generally have high P/E because growth is fast. Mature companies have low P/E because they are stable but have slow growth. Important: don't make decisions based on P/E alone. It varies by sector. Apple's P/E of 30 and Coca-Cola's P/E of 25 are normal. But if a utility company has a PE of 30, it is expensive. Principle 4. Sector analysis. Some sectors perform better under certain economic conditions.
Good in a recession, consumer staples like P&G and Walmart, and healthcare like Johnson & Johnson. Good in a bull market, tech like Apple and Microsoft, and consumer discretionary like Amazon and Tesla. Recommendation for beginners: diversify across sectors. Don't just invest in tech, mix in healthcare, consumer, finance. Practical examples. 3 stock breakdowns. Example 1. Apple, AAPL, growth tech giant. What it does: iPhone, Mac, iPad, services, App Store, iCloud, Apple Music. Why it's good: strong brand, global recognition, ecosystem lock-in, consistent revenue growth last 10 years, high profit margin, 25%, loyal customer base. Risk: high PE, expensive valuation, dependency on China, manufacturing, saturation risk. Everyone has an iPhone now, growth may slow. Who it's for: growth seekers, tech believers, long-term investors. Example 2. Coca-Cola, KO, dividend king. What it does: beverages, Coca-Cola, Sprite, Fanta, Dasani water, etc. Why it's good: 100-year-old brand, global distribution network, moat, consistent dividend, 60-plus years of consecutive increases, recession-proof, people still drink beverages during crises. Risk: low growth, mature company, health trends, soda consumption is declining, currency risk, global operations. Who it's for: income seekers, dividend, stability seekers, defensive investors. Example 3. Johnson & Johnson, J&J, healthcare stability. What it does: healthcare, pharmaceuticals, medical devices, consumer health, Band-Aid, Tylenol. Why it's good: diversified revenue streams, 3 distinct segments, strong R&D, innovation continues, dividend aristocrat, 60-plus years of increases, aging population, demographic tailwind. Risks: legal issues, for example, talc powder lawsuits, regulatory risk, healthcare is heavily regulated, patent expirations, drug patents are expiring, for whom: conservative investors, those who believe in the healthcare sector, those seeking dividends. Starting strategy. 5 golden rules for beginners. Rule 1. Start with index funds, ETF. Your first investment should be in an S&P 500 ETF, not individual stocks, VOO, SPY, IVV, etc. Instant diversification across 500 companies, lower risk, proven track record, 10% average annual return. Individual stocks should make up 20 to 30% of your portfolio later. Rule 2. Invest in what you use. Look at the products you use in your daily life. You use an iPhone, then Apple. You shop on Amazon, then Amazon. You have a Visa card, then Visa. Invest in brands you understand and trust. Rule 3. Dollar cost averaging, DCA. Don't invest all your money at once. Invest a fixed amount monthly. Example: you're going to invest $12,000. Invest $12K all at once, risky, timing matters. Invest $1K every month for 12 months, capture the market average. DCA reduces emotional decision-making. It's automatic. Rule 4. Diversification, 5 to 10 stocks. Don't put all your eggs in one basket. Initial portfolio, 5 to 10 different stocks from different sectors. 2 tech, like Apple, Microsoft, Google. 2 consumer, like Coca-Cola, Procter & Gamble. 2 healthcare, like Johnson & Johnson, Pfizer, United Health. Plus S&P 500 ETF, core holding. Rule 5. Long-term mindset. Don't check stock prices weekly. Monthly is even unnecessary. Buy and hold. Minimum 5 years, ideally 10+ years. Ignore short-term volatility. Focus on the long-term trend. Now, assignment. This week, select 3 companies and research them. A tech company, like Apple, Microsoft, Google. A consumer goods company, like Coca-Cola, Procter & Gamble, Nike. And a healthcare company, like Johnson & Johnson, Pfizer, United Health. For each one, ask, what do they do?
How has their revenue been over the last 5 years? Type AAPL revenue into Google. You'll see it on Yahoo Finance. Are they profitable? Is their net income positive? What is their PE ratio? Available on Yahoo Finance. Do you use this company's products? Do you trust them? Take notes. Make a spreadsheet. Compare them. Don't buy yet. Just research. In the next section, you'll learn about portfolio construction. Then, you'll make an informed decision. If you're ready, let's move on to the next section, portfolio construction and diversification strategy. Chapter 6, Portfolio Construction Strategy, Lehman Brothers Collapse and Diversification. September 2008, Lehman Brothers, the 158-year-old Wall Street giant, went bankrupt. Overnight, zero. There were 2 investors that day. Mark, 80% of his portfolio was in financial sector stocks, Lehman, Bear Stearns, Citigroup, AIG. He believed finance always wins. In September 2008, his portfolio lost 70%. He panicked and sold. He couldn't recover for years. Lisa, his portfolio was diversified. 20% finance, 20% tech, 20% healthcare, 20% consumer goods, 20% bonds or ETFs. The finance sector collapsed, but the others remained stable. Total loss, 25%. He held on, recovered within 2 years, and then returned to profit. What made the difference? Portfolio construction, diversification. Mark did all eggs in one basket. The basket fell, and they all broke. Lisa did eggs in different baskets. One basket fell, and the others held. In this section, we'll learn how to create a smart portfolio like Lisa. Risk distribution, asset allocation, rebalancing. Let's dive in. What if my stock crushes? A beginner's biggest fear. What if I bought a Tesla and it drops 50% tomorrow? Valid fear. Individual stocks are volatile. If you go all in on a single stock, the risk is huge. The solution is simple. Diversify. Don't stick to a single stock. Create a portfolio. Portfolio is collection of investments. Not just one stock, but 10 to 20 different assets. That way, if one falls, the others compensate. There's a saying on Wall Street, diversification is the only free lunch in investing. The only free lunch is diversification. Let's learn how. Portfolio logic. Allocation formula. 60%, 30%, 10% rule. Simple formula for beginners. 60% safe and stable. Core holdings. S&P 500 ETF, VOO, SPY. Large cap blue chip stocks. Apple, Microsoft, Johnson & Johnson. Dividend aristocrats. Coca-Cola, Procter & Gamble. This 60% is the foundation of the portfolio. Even if the market crashes, they will survive. 30%, growth and opportunity. Mid-cap growth stocks. Airbnb, Shopify. High growth sectors. Tech, AI, clean energy. Emerging markets ETFs, EEM. This 30% adds growth to the portfolio. More volatile, but with higher return potential. 10%. Speculative and experimental. Small cap stocks. Individual bets, e.g. new IPO. Crypto, max 5% if you have a risk tolerance. This 10% is the high-risk, high-reward zone. There may be losses here, but leave room for learning. Sector allocation. The portfolio should be diversified not only by stock count, but also by sectors. Example diversified portfolio. 25% technology. Apple, Microsoft, Google. Growth engine. 20% healthcare. Johnson & Johnson, Pfizer, United Health. Defensive, aging population. 15% consumer staples. Coca-Cola, Procter & Gamble, Walmart. Recession-proof. 15% financials. JP Morgan Chase, Visa, Berkshire Hathaway. Economic recovery beneficiary. 10% energy. Chevron, ExxonMobil. Inflation hedge. 10% industrials. Caterpillar, 3M. Infrastructure growth. 5% real estate. REITs. Realty income, American Tower. Passive income, inflation hedge. Thus, if a sector crashes, only part of the portfolio total is affected. Domestic versus international balance. U.S. only investing in stocks. Global diversify, ET. Example: 70% U.S. stocks, S&P 500, individual U.S. companies. 20% international developed markets, Europe, Japan. ETF, VEA. 10% emerging markets, China, India, Brazil. ETF, VWO. From where? Base. Even if the economy declines, the global economy may be in a different cycle. Place of bonds and real estate. Bonds. Lower return but lower risk. Safe haven in market crash. For beginner, 10 to 20% bond ETF. BND, AGG. REITs. Real estate investment trusts. Real estate exposure without investing in real estate. Dividend income, quarterly cash flow. Example: Realty Income, ticker O. The monthly dividend company.
Young investor, 20 to 30 years old, 80 to 90% stocks, 10 to 20% bonds. Middle age, 40 to 50, 70% stocks, 30% bonds. Near retirement, 55 plus, 50 to 60% stocks, 40 to 50% bonds. Rule of thumb: your age equals percent bonds. You are 30 years old, 30% bonds. Simple but effective. Sample portfolios: conservative, balanced, aggressive. Portfolio A: conservative, low risk, age 50 plus. Goal: capital preservation, steady income. Allocation: 40% S&P 500 ETF, VOO, 30% Dividend Aristocrats, JNJ, KO, PG, MMM, 20% Bond ETF, BND, AGG, 10% REITs, O and VNQ. Expected return 6 to 8% annual. Risk level low, minimal volatility. 4, 5 to 10 years until retirement, risk-averse, and income-seeking. Portfolio B: balanced, medium risk, age 35 to 45. Goal: balance of growth and stability. Allocation: 30% S&P 500 ETF, VOO, 25% large cap tech, AAPL, MSFT, Google, 20% growth stocks, NVDA, TSLA, AMZN, 15% dividend stocks, JNJ, V, PG, 10% international ETF, VEA, VWO. Expected return 8 to 10% annually. Risk level medium. There is some volatility, but manageable. Who is it for? Mid-career with a 10 to 20-year horizon, wanting a balanced approach. Portfolio C: aggressive, high risk, age 25 to 35. Goal: maximum growth, long-term compounding. Allocation:
40% high-growth technology, NVDA, TSLA, PLTR, SHOP. 25% S&P 500 ETF, VOO, for stability. 20% emerging markets and sector ETFs, VWO, ARKK, ICLN. 10% small cap growth, individual picks. 5% speculative, crypto, IPOs, experimental. Expected return 12 to 15% plus annually, but volatility is high. Risk level high, 30 to 40% drawdowns possible. 4. Young with a 20-plus year horizon, tolerant of volatility, seeking aggressive growth. Rebalancing. When? How? What is rebalancing?
Initially, 60% stocks, 40% bonds. 1 year later, stocks up 30%, bonds up 5%. Now the portfolio is 65% stocks, 35% bonds. Rebalancing equals return to the original allocation. Sell some stocks, add to bonds. When to rebalance? Option 1, time-based. 1 to 2 times a year. Example, June and December. Simple, automatic, no emotional decisions. Option 2, threshold-based. Rebalance when allocation deviates by 5% or more. Example, your 60% stock target is 66%, rebalance. Once a year is sufficient for most beginners. Over-rebalancing creates transaction costs and taxes. How to rebalance? Method 1, sell high, buy low. Sell the rising, profit-taking, buy the falling, discounted price. Method 2, new contributions. Add new money to the low without selling. Tax efficient, does not trigger capital gains. Example, tech stocks rose significantly, allocation increased to 50%, target 30%. A new $1,000 contribution was received. $0 to tech, $500 to bonds, $500 to dividend stocks. This restores balance. Create a paper portfolio. Now it's time to practice. This week, design a portfolio on paper. Assumption, you'll invest $10,000. Determine your allocation, 60, 30, 10%, or your own formula. Determine your sector allocation, tech X%, healthcare Y%, etc. Select specific stocks or ETFs, 3 to 5 ETFs, core holdings, 5 to 10 individual stocks, 1 to 2 bond or REIT. Template, total $10,000. Core holdings 60%, $6,000. VOO, S&P 500, $3,000. VTI, total market, $2,000. BND, bonds, $1,000. Growth, 30%, $3,000. AAPL, $800. MSFT, $700. NVDA, $700. AMZN, $800. Speculative, 10%, $1,000. Your pick, $500. Your pick, $500. Don't deposit real money yet. This is an exercise. Make a spreadsheet and track it. After a month, observe how it performed.
Paper trading is the best teacher. There's no risk, but there is experience. In the next section, we'll learn how to avoid emotional traps, FOMO, panic selling, and greed. Prepare to win the psychological warfare. Chapter 7. Avoiding Emotional Traps. GameStop Frenzy 2021. January 2021, the Wall Street Bets community on Reddit targeted GameStop stock. A typical video game retailer, the stock price is around $20. In a week, it skyrocketed from $20 to $483, a 2,300+ increase. Kevin, a 28-year-old software engineer, sees the hype on Reddit daily. Everyone's making money, everyone says. FOMO, fear of missing out, kicks in.
At $483 at its peak, Kevin invested $10,000. He thought, this is going to $1,000. A week later, it fell to $40. Kevin's $10,000 had melted away to $800, a 92% loss. He panicked. He sold. He realized a loss. The same story has happened to thousands of people. Why? Because they made emotional decisions. Emotion, not logic. Now, I'll introduce you to your biggest enemy, the person you see in the mirror, and I'll teach you how to defeat that enemy. The cycle of fear and greed. There's a saying on Wall Street, the market is driven by two emotions, fear and greed. Greed, when the market is rising, more. Risky decisions, FOMO, over-leverage. Fear, when the market is falling, I'm going to lose it all. Panic selling, exit at the bottom, don't miss an opportunity. This cycle has been repeating for centuries. 1929 Great Depression, 2000 dot-com bubble, 2008 financial crisis, 2020 COVID crash, 2021 meme stock frenzy. Every time it's the same story. Greedy ones enter at the peak, fearful ones exit at the bottom, and every time the calm and rational ones win. Now, let's identify those traps.
Psychological traps. Trap 1. FOMO, fear of missing out. Scenario: Tesla rose 100% in 3 months. Everyone's talking. You didn't buy. You say, I wish I had. Now at the peak, you think, I'll buy it before it's too late. Result? You buy at the peak. Soon after, a correction occurs, dropping 30%. You're in a loss. Reality: every stock that goes up eventually corrects. Timing is impossible. Late FOMO is always expensive. Solution: when you say, I'm late, don't buy. Wait for the next opportunity. There's an opportunity in the market every day. Warren Buffett says, the stock market is designed to transfer money from the impatient to the patient. Trap 2. Panic selling. Scenario: your portfolio drops 20%. Media headlines read, recession is coming. You're scared. You say, let's sell before I lose more. Result: you sell at the bottom. The market recovers and you're on the outside. You miss the gain. Reality: market crashes are normal. The S&P 500 drops 20+% every 3 to 5 years on average, but it recovers and makes new highs each time. Example: 2020 COVID crash. March 2020, the S&P 500 fell 34%. Panic sellers realized a 34% loss. Holders break even in December 2020 plus 20% profit in 2021. Solution: never sell during a crash. In fact, if you have cash, buy, buying the dip. Peter Lynch says, far more money has been lost by investors preparing for corrections than has been lost in corrections themselves. Trap 3. This time is different fallacy. Scenario: 2021 crypto boom. Bitcoin hit $60,000. You think, this time is different. Bitcoin will go to $100,000. Traditional finance is dying. Result: you buy at the peak. Bitcoin falls to $15,000. 75% loss. Fact: this time is different are the 4 most dangerous words. History repeats. Bubbles always burst. Sample date: 1999. The internet will change everything. .com crash. 2007. Real estate always goes up. Housing crash. 2021. Crypto is the future. Crypto winter. Solution: return to fundamentals. Ignore the hype. Valuation is important.
Trap 4. Loss aversion, or fear of loss. Psychology. People are twice as affected by the pain of losing $100 as they are by the joy of winning $100. Scenario: you buy a stock and it falls 10%. You say, I'll sell it when it breaks even. but it keeps falling. You hold on because you don't want to realize the loss. Result? You're stuck with the bad stock. You don't have the cash to buy good stock. Solution: set a stop loss. Cut when the loss reaches 15 to 20%. Let go of your ego. Accept the wrong decision and move on. Cut your losses short. Let your winners run. True stories. Sellers versus holders. 2008, financial crisis. Sellers, March 2009, bottom. S&P 500, 666, the lowest point. Portfolio lost 50%. Panic, sold. Loss became permanent. Holders, same 50% loss. Held, some even bought more. 2013, break even. 2020, plus 200% profit in 11 years. Lesson: worst time to sell, best time to buy. 2020 COVID crash, same story, different year. March 2020, market fell 34% in 1 month. Sellers realized loss, remained sidelined. Holders, August 2020, break even. December 2020, plus 10%. 2021, plus 30%. Tech investors holding Apple, Microsoft, Amazon, 50 to 100% gain 1 year. Kevin's story, different Kevin, the good one. In March 2020, Kevin's portfolio fell from 50K to 33K, a 34% loss. His friend said, "Sell, it'll fall even further." Kevin thought, "I'm 25. I have 40 more years. This crash is just a blip in 40 years." He didn't sell. In fact, he continued to auto-invest $500 every month. He bought more stocks at low prices. 2025, portfolio 180K, 260% growth in 5 years. Lesson: time in the market beats timing the market. Techniques for dealing with emotions. Technique 1. Dollar cost averaging, DCA. Eliminate emotional decisions. Invest a fixed amount every month, whether the market is up or down. Why it works? At high prices, you buy fewer shares. At low prices, you buy more shares. Average cost is optimal, and you eliminate emotional bias.
Example: you invest $500 every month for 6 months. Month. Price. Shares bought. 1. $100. 5. 2. $80. 6.25. 3. $60. 8.33. 4. $80. 6.25. 5. $100. 5. 6. $120. 4.17. Total: you invested $3,000 and bought 35 shares. Average cost $85.71. If you had invested all $3,000 in month 1, you would have received 30 shares, averaging $100. 14% more shares with DCA. Technique 2. Set and forget. Set your portfolio and forget. Rules: don't check prices daily. Don't check weekly. Once a month, 15 minutes is sufficient. Or quarterly, every 3 months. Why? Because daily volatility creates an emotional reaction. A 5% drop, panic. A 5% rise, greed. Long-term trend is important. Short-term noise is not. Technique 3. Don't watch CNBC. Financial news sells fear and hype because attention is the economy. Market crash coming. That gets clicks. Market normal, stable growth continues. That's boring, doesn't get clicks. Recommendation: avoid the news. Quarterly earnings reports are sufficient. Don't pay attention to the noise. Technique 4. Write your why. Why are you investing? Write it down. I'm investing to pay off my kids' college funds in 20 years. I'm investing to retire early and travel the world in 30 years. When you're in a panic, read this why. Counter short-term pain with a long-term goal. Write your emotional decision. Assignment. Recall a past emotional investment decision and write it down. What did you do? Did you buy out of FOMO? Did you sell out of panic? What was the outcome? What did you learn? What would you do again? This exercise builds self-awareness. Admitting you made a mistake is the first step. Now make a commitment. I, your name, promise not to make emotional decisions. I will review my portfolio once a month. I will not panic sell. I will not buy based on FOMO. I will implement my DCA strategy. Write it down, sign it, take a picture, use it as your phone wallpaper. The next time you panic, look at this. In the next section, we'll learn about risk management and capital protection. Not losing is as important as winning. If you're ready, let's continue.
Chapter 8. Risk Management and Capital Protection. Math don't lie. 2022. A crypto investor. Mike is a 30-year-old tech worker. He's heavily invested in Bitcoin and altcoins. His portfolio has lost 80% in 6 months. It fell from $100,000 to $20,000. Mike thought, okay, I lost 80%. Now if I make 80%, I'll be back. His math teacher friend laughed. Mike, it doesn't work that way. To go from $20,000 to $100,000, you need to make 400%, not 80%. Mike shocked. What? Here's the brutal truth. If you lose 50%, you need to make 100% to come back. If you lose 80%, you need to make 400%. If you lose 90%, you need to win 900%. Loss creates exponential damage. Recovering becomes exponentially more difficult. That's why Warren Buffett's #1 rule is, don't lose money. Rule number 2, don't forget rule number 1. In this section, we'll learn not to lose, because wealth building starts with avoiding big losses, not big gains. The get-rich-quick trap. Most beginners' goal is get rich quick. That's why they buy high-risk penny stocks, they go all in on crypto, they trade options without knowing anything, they use leverage, invest with borrowed money. The result? 90% of them lose money. Truth. Get rich quick rarely works. Get rich slow almost always works. Tortoise versus hare. Slow and steady wins the race. Now I'll teach you how to minimize losses and protect your capital. Risk management rules. Rule 1. 2% risk rule. Position sizing. Principle. Risk a maximum of 2% of your total portfolio on a single trade or stock. Example. Portfolio, $10,000. Maximum risk per position, $200, or $10,000 times 2%. Let's say you buy Apple stock at $180 per share. You set your stop loss at $162, a 10% decline. Risk per share, $18. 180 minus 162. How many shares should you buy? Max risk divided by risk per share equals 200 divided by 18 equals 11 shares. So you can buy 11 shares, $1,980 investment. If the stop loss triggers, you lose $198, 2% of your portfolio. Why it's important? Even if you make the wrong decision 50 times, your portfolio will only lose 50%, 2% times 50. You have a chance to recover.
Rule 2. What is a stop loss and how to use it? A stop loss, an automatic sell order. When the stock falls to the price you specify, it is automatically sold. Example: you buy Tesla stock at $250. You set a stop loss of $225, or a 10% decrease. If the stock falls to $225, it is automatically sold. You cut the loss at 10%. Stop loss levels: conservative, 5 to 7%. A tight stop, frequently triggered. Moderate, 10 to 15%. Balanced. Aggressive, 20 to 25%. Wide, allows for volatility. Important: setting a stop loss requires discipline. Let go of your ego and accept the loss. Don't say, maybe it will bounce back. Maybe it will fall another 50%. Rule 3. Emergency fund first, invest later. Critical rule: create an emergency fund before investing. Emergency fund: 3 to 6 months of living expenses in a high-yield savings account. Why? Let's say all your money is in stocks. An unexpected expense, car repair, medical bill, job loss occurs. You don't have any cash. You have to sell the stock. But the market is down 20% that day. You realize a loss. If you have an emergency fund, you don't touch the stock. You wait until the market recovers. Formula: monthly expense, $3,000. Emergency fund, $9,000 to $18,000, 3 to 6 months. Keep this money in high-yield savings, current rate around 4 to 5%. Don't put it in the stock market. Rule 4. Diversification. Emphasis again. The #1 tool in risk management. Example: bad scenario. 2020 airline industry. COVID hit. Airlines crash, down 70 to 80%. If 100% of the portfolio is in airline stocks, it's devastated. If 10% of the portfolio is in airline stocks and 90% is diversified, it's manageable. Rule: a single stock should be a maximum of 10% of the portfolio. A single sector should be a maximum of 25%.
Crisis scenarios. What to do? Scenario 1. The market crashes 30%, like 2020 COVID. Don't panic sell. Constantly check portfolio. Obsess over news. Do nothing. Hold. If you have cash, buy opportunity. Buy at a discount. Continue DCA, automatic investing. Look at your long-term plan. Remind yourself. Historical fact: the S&P 500 has recovered and made new highs after every crash. 100% success rate, 100+ years. Scenario 2. Recession indicators. Recession indicators: inverted yield curve, 2-year versus 10-year Treasury. Rising unemployment, declining GDP. What to do? Increase defensive stocks, healthcare, J&J, consumer staples, PG, KO, utilities. Decrease growth stocks, high-risk tech, speculative plays. Increase bonds, safe haven. Hold cash position, 10 to 20% cash for buying opportunities. But timing a recession is impossible. Even experts are only 50% accurate. If you're a long-term investor, ignore the recession. Scenario 3. Black swan events such as 2008-2020. Black swan, an unexpected catastrophic event. Examples: 2008 Lehman collapse, 2020 global pandemic, 2001 9/11. What to do? Before, make sure you have an emergency fund, 3 to 6 months. During, do nothing, wait. After, find an opportunity. A crash is a buying opportunity.
Warren Buffett, be fearful when others are greedy, and greedy when others are fearful. Protection strategies. Strategy 1. Hedging basics. Hedging. Take an opposing position to protect your portfolio. Simple example. Your portfolio is tech-heavy. You're afraid of a tech crash. Hedging options? Buy inverse tech ETFs like SQQQ. When tech goes down, it goes up. Buy put options. Advanced. I don't recommend them for beginners. But be careful. Hedging costs money. It's like insurance. Hedging costs money. Beginner's advice? Instead of hedging, diversify. Simpler, cheaper. Strategy 2. Bonds and gold. Bonds are a safe haven in a market crash. When stocks fall, bonds rise, usually. Gold is inflation hedge. When the dollar depreciates, gold rises.
Allocation. Young, 20 to 30, 5 to 10% bonds, 5% gold commodities. Middle-aged, 40 to 50, 20 to 30% bonds, 5 to 10% gold. Nearing retirement, 55 plus, 40 to 50% bonds, 10% gold. Strategy 3. Insurance analogy. Think of risk management like car insurance. Why would you buy car insurance? The probability of a crash is low, 5 to 10%. But if it does, it could lead to financial devastation. Insurance protects you. Investment insurance, stop loss, diversification, emergency fund, asset allocation, bond, stock balance. There's cost, but there's peace of mind, acceptable trade-off. Portfolio risk audit. Assignment. Identify the riskiest 10% in your portfolio. Open a spreadsheet and list all your holdings. Enter a risk level for each, low, medium, high. Identify high-risk ones. Ask yourself, this position is X% of my portfolio. Am I comfortable? How would I feel if it fell by 50%? Is there a stop loss? If you're uncomfortable, reduce your position size, add a stop loss, or sell, switch to a lower-risk asset. Remember, sleep well test. If you can't sleep because of your portfolio, you're taking too much risk. In the next section, we'll learn how to win the long-term game. Patience is the most profitable investment strategy. If you're ready, let's continue. Chapter 9. Winning the Long-Term Game. Seattle Teacher's Amazon Story. 1997, Seattle. Kristen, a 32-year-old high school math teacher, earns $42,000. That year, Amazon.com IPO'd, Jeff Bezos' online bookselling startup. IPO price, $18 per share, split adjusted 10 to 15%. Kristen thought, online bookselling is interesting, I'll try it. She invested $10,000, half her savings. She took a risk. First year, stock rose 100%, then fell 50%. Volatility was insane. 2000, dot-com crash, Amazon fell 90%, from $100 to $7. Everyone said Amazon is going under. Her friends said sell, it'll fall even further.
Kristen, math teacher. The math worked. I buy books from Amazon, others buy them too. The business model makes sense, I'll hold on. Here we are in 2025, 28 years later. Kristen's $10,000, approximately $12+ million. Yes, you heard that right, 10K to 12 million plus, 120,000% return. Kristen is now 60 years old. She retired early 5 years ago. She travels the world, spends time with her grandkids, and every day she says, I'm glad I kept it. Secret? Patience, long-term vision, ignoring short-term noise. Now I'm going to teach you how to win the long-term game. I want to get rich quick, urgency. Most people, 10 years is too long. I want to get rich in 2 years. This is why. They day trade, 95% lose money. They buy penny stocks, most are scams. They YOLO meme stocks, like GameStop, AMC. The result? Loss, frustration. They say investing doesn't work. Truth? Investing works, but a time horizon is essential. 1-year investor? Gambler.
10-year investor, investor. 30-year investor, wealthy. Now let's prove it with math and history. The logic of the long term. Mathematical fact. Volatility declines. S&P 500 historical data 1926 to 2024. 1-year return range. Best year, plus 54%, 1933. Worst year, minus 43%, 1931. Range, 97 percentage points. If you invest for 1 year, you can gain 54% or lose 43%. Huge volatility. 10-year average annual return range. Best 10-year, plus 20% average annual. Worst 10-year, minus 1% average annual. Range, 21 percentage points. The S&P 500 has not lost in any period of 20 years, 100% positive.
30-year average annual return. Each 30-year period, plus 10 to 11% average annual. 0 loss periods. Lesson: time eliminates risk. Longer you hold, safer you become. Tax advantage. Short-term capital gains, less than 1 year, ordinary income tax rate, 22 to 37%. Long-term capital gains, greater than 1 year, 0%, 15%, or 20% based on income. Example, you bought stock for $100, it went up to $150, $50 profit. Scenario A, sell in 6 months, short-term gain $50, tax 32% bracket, $16, net $34. Scenario B, sell in 2 years, long-term gain $50, tax 15% bracket, $7.50, net $42.50. Long-term hold, 25% more net profit, plus compounding continues. Compounding superpower. Emphasis again. 1 year, linear growth. 10 years, exponential growth. 30 years, explosive growth. $10,000 investment, 10% annual return, year, value, gain that year. 1, $11,000, $1,000. 10, $25,937, $2,357. 20, $67,275, $6,116. 30, $174,494, $15,863. In that year, what you earn alone is more than your entire investment in the first year. This is the magic of compounding, and this magic is activated over time. Successful long-term examples. Warren Buffett, 60-year journey. Warren Buffett bought his first stock at the age of 11, 1942. He is now 94 years old. Net worth progression. Age 30, 1960, $1 million. Age 40, 1970, $25 million. Age 50, 1980, $376 million. Age 60, 1990, $3.3 billion. Age 70, 2000, $28 billion. Age 80, 2010, $47 billion. Age 90 plus, 2020 plus, $120 plus billion. Note, 95% of your net worth came after age 60. Why? The last 30 years of compound interest have been stronger than the first 50 years. Lesson: start early, never quit. Magic happens eventually. Peter Lynch, Fidelity Magellan Fund. Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990. Performance: average annual return for 13 years, 29%, beats S&P 500 by 13.4%. $18 million fund to $14 billion fund. Strategy: invest in what you know, long-term hold, patience. Lynch's famous quote, "The stock market is filled with individuals who know the price of everything but the value of nothing." Short-term traders look at the price. Long-term investors look at value.
S&P 500 100-year track record. The S&P 500 has been around since the 1920s. 100-plus year average annual return about 10%. In these 100 years, the Great Depression, 1929, World War II, 1970 stagflation, 1987 Black Monday crash, 2000 dot-com bubble, 2008 financial crisis, 2020 COVID pandemic. After each crisis, it recovered and made new highs.
$10,000 in 1926 to $140+ million in 2024 with dividends reinvested. Lesson: bet against America, bet against human progress. History shows, bad bet. Techniques to stay disciplined. Technique 1. Automatic monthly contributions. Don't invest manually, do it automatically. Setup: 1 day after paycheck, automatic $X transfer. Goes to brokerage account. Automatic S&P 500 ETF purchase. You'll forget about it. The system works. Psychological benefit: market up, down, no emotion, autopilot mode. Technique 2. Quarterly review only. Do not review daily, weekly, or even monthly. Mark your calendar: March 31st, June 30th, September 30th, December 31st. 4 times a year, 15 minutes. What's the review for? Is rebalancing necessary? Can I increase my contribution? Is my allocation still suitable? Just that, no more. Technique 3. Every time you buy a stock, ask, can I hold this for 10 years? If the answer is no, don't buy it. Warren Buffett's rule is, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Think about long-term ownership, not short-term trading. Technique 4. Ignore the noise. Financial media generates noise. It sells drama. Headlines: market crash incoming, top 5 stocks to buy now. Is this the end of the bull run? Ignore clickbait. A true long-term investor doesn't read headlines. Warren Buffett lives in Omaha, doesn't watch TV, and isn't on Twitter. He only reads company annual reports. You should do the same.
Write a 10-year investment plan. Assignment: write a 10-year investment plan. Commit. Template: 10-year investment plan. Name, start date, end date. Goal: portfolio value, dollars. Purpose: monthly contribution. Total over 10 years. Strategy: core holding, S&P 500 ETF. Growth stocks. Dividend stocks. Rules I will follow: never panic sell during crash. Review only quarterly. Increase contribution 10% annually. Hold for minimum 10 years. Commitment: I commit to this 10-year plan. I will not deviate during market volatility. I trust in long-term compounding. I will not check prices daily. I will be patient. Signature. Date. Print, sign, frame. Hang on the wall. In 10 years, you will look at this document and say, best decision ever. In the next and final section, you will combine all you've learned and take the first step. 30-day action plan. The beginning of your financial freedom journey. If you're ready, let's move on to the final section. Chapter 10. The first step to financial freedom. Take action now. The you at the beginning of the book versus the you now. Remember? At the beginning of the book, we started with the story of Michael and David. Graduates from Ohio State, same salary, different decisions. That story could have been your story. Now, 2 hours later, you're a different person. Now you know the difference between a wealthy mindset and a broken mindset, the explosive power of compound interest, that time is just an excuse. Stock is ownership, not a casino. How to choose a quality company. How to build a portfolio. How to avoid emotional traps. How to manage risk. How to win a long-term game. You're ready now, but knowledge without action is powerless.
Write a 10-year investment plan. Assignment: write a 10-year investment plan. Commit. Template: 10-year investment plan. Name: your name. Start date: today's date. End date: 10 years from today. Goal: portfolio value, dollar amount. Realistic, based on contribution plus 10% return. Purpose: retirement, house down payment, or financial freedom. Monthly contribution: dollar amount. Total over 10 years. Dollar amount. Monthly times 120. Strategy: core holding, S&P 500 ETF, percentage. Growth stocks, names of companies, percentage. Dividend stocks, names of companies, percentage. Rules I will follow. 1. Never panic sell during crash. 2. Review only quarterly. 3. Increase contribution 10% annually. 4. Hold for minimum 10 years. Commitment. I, your name, commit to this 10-year plan. I will not deviate during market volatility. I trust in long-term compounding. I will not check prices daily. I will be patient. Signature. Date. Print, sign, frame. Hang on the wall. In 10 years, you will look at this document and say, best decision ever. In the next and final section, you will combine all you've learned and take the first step, 30-day action plan, the beginning of your financial freedom journey. If you're ready, let's move on to the final section. Chapter 10. The first step to financial freedom. Take action now. The you at the beginning of the book versus the you now. Remember? At the beginning of the book, we started with the story of Michael and David, graduates from Ohio State. Same salary, different decisions. That story could have been your story. Now, 2 hours later, you're a different person. Now you know the difference between a wealthy mindset and a broken mindset. The explosive power of compound interest. That time is just an excuse. Stock is ownership, not a casino.
Isaac Newton said, "An object at rest remains at rest. An object in motion moves." You are now at that critical moment. You will either remain stagnant, nothing will change, or you will take action. Your life will transform. Now, I will give you a 30-day action plan, step by step. No excuses, just action. Let's go. Journey recap. What did we learn in 9 episodes? Quick summary, reinforcement. Part 1, mindset. Wealth is not an amount, it's a way of thinking. You chose wealthy mindset. Part 2, compound interest. Einstein's 8th wonder. Start early, never quit. Jake versus Tyler, the early bird wins. Part 3, time management. I don't have time is a lie. You have 7 hours of screen time a day, so you can dedicate 30 minutes to financial education. Chapter 4, stock basics. Stock equals ownership. You became a shareholder of Starbucks. NASDAQ, NYSE, ticker symbols. You got it. Chapter 5, stock ticking. Warren Buffett's principle. Invest in companies you understand. 5 characteristics of a quality company. Apple, Coca-Cola, Johnson & Johnson. Chapter 6, portfolio. The 60-30-10% rule. Diversify. Conservative, balanced, aggressive models. Rebalancing. Chapter 7, psychology. Your biggest enemy is the person you see in the mirror. FOMO, panic selling, loss aversion. DCA, set and forget. Chapter 8, risk management. Rule number 1, don't lose money. The 2% risk rule. Stop loss, emergency fund, protection. Chapter 9, long term. Kristen's Amazon story. 10K to 12 million. 28 years. Patience is profit. 10-year commitment. Now it's time for action. 30-day action plan. Week 1, foundation. Days 1 and 2, financial goal setting. Sit down and write on a piece of paper
What do I want my portfolio to be worth in 10 years? Be realistic. Monthly contribution times 120 months times compound effect. Write down your purpose. Why am I investing? Retirement? House? Freedom? Days 3 and 4. Platform research. Research Fidelity, Vanguard, Charles Schwab, Robinhood. Read reviews, compare features. Choose Robinhood or Fidelity if you're a beginner. Days 5 to 7. Account opening. Open a brokerage account. 15 minutes online. SSN, ID, bank information. Make your first deposit anything, even $50. Complete the setup. By the end of week 1, account is open, funded, and ready.
Week 2, Portfolio Design, Paper Trading. Days 8 through 9. Select Core Holdings. S&P 500 ETF, VOO or SPY. 50 to 60% of portfolio. Total Market ETF, VTI, alternative. Bond ETF, BND, age-based percentage, 10 to 20% if you're young. Days 10 through 12. Select individual stocks. Select 5 to 7 companies based on the criteria you learned in previous sections, from different sectors: tech, healthcare, consumer, finance. Conduct research, PE ratio, revenue growth, brand strength. Days 13 to 14. Create a paper portfolio. Create a spreadsheet. Assume $10,000. Write down the allocation: 60% ETF, 30% stocks, 10% speculative. Don't buy yet, just design. By the end of week 2, portfolio design is ready on paper. Week 3, first purchase, first blood. Day 15, first ETF purchase. Open your brokerage app. Search for VOO or SPY. Click the Buy button. Enter a dollar amount, example, 100, 500, whatever. Market order. Submit. Congratulations, you are now a shareholder of 500 companies. Day 16 through 17, first individual stock. Pick the stock you're most confident in, example, Apple. Start small, $50 to $100. Use fractional shares. You can even buy a 0.5 share. Emotional test. The first purchase is always exciting. Day 18 through 20. Build your portfolio. Pick 2 to 3 more stocks from different sectors. Follow the allocation 60, 30, 10. Total investment, the amount you're comfortable with. Day 21. Review. Look at your portfolio. Is the allocation correct? Do you feel comfortable? If not, adjust. At the end of week 3, first portfolio is live, real money has been invested. Week 4, automation and systems. Days 22 through 23, auto invest setup. Days 22 through 23, auto invest setup. Find automatic investment or recurring buy in brokerage. Set monthly contribution, $100, $500, $1,000, whatever. Choose date, 1 to 2 days after paycheck. Choose target, VOO or VTI, core holding. Activate. Days 24 through 25, budget optimization. Review expenses for the last 30 days. Unnecessary subscriptions. Cancel. Unused Spotify or gym. Redirect that savings to investment. Days 26 through 27. Emergency fund check. Do you have an emergency fund? 3 to 6 months expense.
Otherwise, invest in high-yield savings in parallel. Emergency funds are as important as investments. Days 28 through 30, calendar setup. Mark quarterly review dates, March, June, September, December. Annual contribution increase reminder, increase by 10% each year. 10-year anniversary date, check my progress reminder. At the end of week 4, system is automatic, hands-off mode, sustainable.
Common obstacles and solutions. Obstacle 1. No money. I can't start. Solution. Start with $10. You could even buy Apple with fractional shares. Skip your monthly Starbucks for one day and invest that $6. Math. $6 a day times 30 days equals $180 per month, $2,160 per year, approximately $370K in 30 years with compounding. Don't say you don't have money. Say you don't have a priority. Be honest. Obstacle 2. I'm afraid. What if I lose money? Solution. Start small. Test with $50, 1% of your total net worth. Start with an S&P 500 ETF, 100-year track record, 10% average. If you have an emergency fund, don't be afraid. Stock losses are not life losses. Risk comes from not knowing what you're doing. Buffett. Now you know. You are taking educated risks. Obstacle 3. I don't know much. I need to learn more. Solution. Don't let analysis paralysis take you. This audiobook is sufficient. You don't need a PhD to get started. The best time to plant a tree was 20 years ago. The second best time is now. Learn by doing. You don't learn by reading, you learn by doing. Obstacle 4. I don't have time. I'm busy. Solution. You've set up automation. 15 minutes a month is enough. You spend 10 hours on Netflix? Can't find 15 minutes? Priority is a problem, not a time problem. Success stories. Your future story. Chris's story, Denver, Colorado. In 2005, Chris was a 30-year-old graphic designer. He was earning $55,000 annually. That year, he decided, I'll invest $500 every month for 20 years, no matter what.
Journey. 2008 crisis. Portfolio fell 40%. He didn't sell. He kept going. 2015, salary increased. Contribution increased to $800. 2020 COVID, falls again, holds again. 2025, portfolio $485,000. 20 years later, Chris is 50. This year, he quit his job, early retirement. Now he hikes in Colorado, spends time with his grandkids, and takes up photography. Best decision of my life, he says. If I hadn't started 20 years ago, I'd still be working the 9-to-5 grind. Your potential 20-year future. Now let's sketch out your scenario. Assumptions. Age, 30. Monthly contribution, $500. Annual return, 10%, S&P 500 average. Time horizon, 20 years. Result at age 50? Total contribution, $120,000. Portfolio value, $382,000. That's just $500 a month. What if you invested more? What if you started earlier? $1,000 a month, 20 years, $765,000. $500 a month, 30 years, $1,028,000. Here's your potential future. The math doesn't lie. You just need to start. Empowering message. You can do it. Now I'll tell you one last thing. It's very important. You can do it. You don't need to come from a rich family. You don't need a Harvard degree. You don't need to work on Wall Street. Warren Buffett came from Nebraska, a middle-class family. Peter Lynch grew up in Boston in a normal family. Kristen was a math teacher. Chris was a graphic designer. They were all normal people. The only difference was they started, and they didn't quit. You're not alone. Millions of people are on this same journey right now. There's the r/Boogleheads community on Reddit. There are personal finance blogs. There are podcasts. You are part of a community. Every great journey begins with a single step. Those who climb Everest started at base camp. Those who run marathons started with a mile run.
Your first step. Invest your first $100 this month. Financial freedom is a right, not a luxury. Everyone deserves it. You are too. But you must fight for it. No one will give it to you. You must take it. Today is the first day of your future. Not tomorrow, not next month, today. Take action today. Now, after finishing this audiobook, here's what to do. Step 1. Open your calendar. Type Financial Freedom Journey Starts and mark today's date. Step 2. Select a brokerage. Fidelity, Vanguard, Robinhood. Which one is right for you? Step 3. Open an account. Today or tomorrow, 15 minutes. Don't delay. Step 4. Make your first deposit. $50, $100, $500, whatever. The amount doesn't matter, the action does. Step 5. Share with a friend. Say, I started investing today. Accountability partner. You've committed, you can't go back. Step 6. Set an alarm for 1 year from now. Set an alarm for 1 year from now. Text, you started 1 year ago, look at your portfolio. Thank yourself. And most importantly, step 7, don't give up. The market will fall. Don't panic. The news will be scary. Ignore it. Your friends will say risky. Don't listen. You know it. The long-term game, the winning game. You made a decision today. That decision could make you a millionaire 20 years from now. Or you'll do nothing and say, 20 years from now, I wish I'd started. The choice is yours. The power is in your hands. Now go and start. I believe in you. Because you finished this audiobook. 99% of the time, they won't even make it here. You did. You were different. Welcome to the journey. Welcome to financial freedom. A beginning, a promise. Thank you for listening this far. This wasn't just an audiobook. This was a transformation. You are not the same person you started with 2 hours ago. You are now an informed, empowered, and ready investor. You've become part of a community. Millions of people are on the same path. Share, learn, grow. A year from now, email me or tag me on social media. Say, it's been a year, I looked at your portfolio, thanks. I'd love to see it. Your success story will inspire others.
And remember, the best investment you can make is in yourself. Warren Buffett. You invested in yourself by listening to this audiobook. Now invest in the financial markets. Last word. Today is the first day of your future. I'm so glad you started. Now go, take action, build wealth, achieve freedom. You can do it. I believe in you.